Hello and welcome back to the demo portion dealing with retained earnings. So in this video I want to do two exercises. First exercise I want to do is exercise 14-7, which I believe is on page 635. At least that's what it is according to the ebook. And then the next one, or the second problem example we're going to work on is exercise 14-8. Which appears to be on the same page 635. So please pull out your books, okay? Read over the problem. Exercise 14-7 has to deal with making adjustments, okay? Now, before preparing financial statements for the current year, the chief accountant for Tasso Company discovered the following errors in the accounts. The key point here is that we're going to fix these incorrect journal entries before we actually prepare the financial statements. So we're catching them before we prepare the financial statements, right? That means that we do not need to hit retained earnings now. Right? The reason why is we haven't prepared the financial statements yet. We caught the mistake before we went further and prepared those financial statements. So we're going to go through on how to exactly book the correct entries, right? Because the instructions say prepare the correcting entries at December 31st. And then it says prepare we don't have to prepare a retained earnings statement. That's not part of the instructions. That's just what this problem. It's a learning objective. This problem goes to. Okay, or that's the knowledge they're trying to get you to practice. Okay, so first thing I'm going to do, I'm just going to create our journal here again. It's arbitrary, just trying to make it look nice, right? Oh, excuse me. Okay, there we go. Commas, get rid of my decimal places. Okay. All right, and then we have our accounts. And then obviously we have our date. Now, because we recognized all this happened before we prepared the financial statement, so all our adjustments are going to be made as of 12/31. They don't give us a year. That's okay. As long as you know it's 12/31, we'll be good. Okay, so let's look at the first one. Number 1 says the declaration and payment of $50,000 cash dividends was recorded as a debit to interest expense, $50,000, and a credit to cash for $50,000. Okay, so for the sake of demonstration purposes, I'm going to book what they did. Okay, and I'm going to make this bold, right, just so you could tell the difference, just so we could see what exactly did they do. Right, they told us that they debited interest expense for $50,000 and they credited cash for $50,000. Okay? And I'm going to make all this bold just so we know, okay? And this is just for us to give us an idea of what we're doing, right? What's the problem here? Well, the problem is we hit the totally wrong account, right? We have $50,000 of an interest expense that isn't even right? Nowhere in the problem does it say we paid interest, right? No. It says we declared and paid a $50,000 cash dividend. When we did that, we made the journal entry like we see on here on the screen. Interest expense, cash. We know that's wrong, okay? What we should have done was we should have, and I'm going to come here. Actually, let's do it this way. I'm going to make it red. Okay. Red means that's wrong, right? What should we have done? Well, what we should have done is we should have debited cash dividends distributable, right, for $50,000, and we should have credited cash for $50,000, right? I'm going to make this green by saying, hey, here's what we should have done. This would have been correct had we done it right. Ooh, that's bad. Green's not a good color. Let's make it bold. Actually, let's make it blue. That looks like it's a little easier to see. Okay. So what we need to do is take into account what we did, debited interest expense, and should have debited cash dividend distribution or cash dividends, however you want to word it's fine with me. So how are we going to fix this? Well, very, very simple. First thing we're going to do is we need to recognize that we have $50,000 of an interest expense should not be there, okay? And just kind of as a reminder, pick out what you know, right? Fix what you know, and then we can piece the other part in there very, very easily, right? So we have an interest expense of 50 grand that should not be there. We got to back it out. Well, how do we back out this journal entry? Very simple, right? We need to credit interest expense for $50,000. That's the correct, that's how we get rid of the interest expense that we previously booked, okay? So we need a debit now. Well, we know we should have debited cash dividends. So that's going to be our debit for $50,000. Okay. What we did here was take the interest expense away and put it into the cash dividend where it should have been. Okay. So this one in bold black, that's the correct answer. Okay. Now let's look at number 2. And I'm going to change these to reflect the number that we're doing in the example, okay? Okay, so a 10% stock dividend, 10,000 shares, was declared on a $10 par value stock when the market price share was $18. The only entry made was stock dividend 10,000 and dividend payable credit of 10,000. The shares have not been issued. Okay, so we didn't issue the shares yet. Okay, so what we need to do is to fix this, right? So here's what we're going to do. We're going to, in red, book what the problem said we did. Okay, so they said that the interest or the entry that we made was a stock dividend debit of $10,000 and a credit to dividend payable for $10,000. Okay. Now, what's the problem? Well, to figure that out, we need to look at, bring us into screen, the problem, right? A 10% stock dividend. Is that a small dividend or a large dividend? Well, remember, our threshold's at 25%. Anything under 25% should be a small stock dividend. So it's a small stock dividend. Good. Now we need to think back. What value should we use? They used 10,000. Well, where in the hell did they get $10,000 from? Oh, they used the par value. Look, Par value, $10 per share, 1,000 shares, they use the par value. Do we use the par value for a small stock dividend? And I'm hoping that everybody's answering me, but I guarantee there's probably a handful of you aren't. That's okay. Why aren't you answering me? Well, you don't know the answer. Okay, not a problem. So if you don't know this, you need to go back to that slide, take notes on that, and study that and memorize that. When we have a small stock dividend, when we have a small stock dividend, we have to use the market price, not the par value. Okay? That's what they did. So right off the bat, we know that they didn't do too good here, right? They didn't do good at all. Okay? So let's look at it this way. What should we have done? And bear with me here. I'm just going to move this out of the way. All right. It's like magic, huh? Okay, so what should we have done, right? When we issue stock or a stock dividend, what do we need to do? And I'm hoping you're answering me in your head, right? But let's do it this way. Here's what we should do, okay? The correct thing to do would be debit stock dividend for how much? Well, remember, we're using the market, right? So 1,000 shares times, the problem tells us that it is, bear with me, I just need to go back and look, $18. So we should take 1,000 times our $18, and we should debit this for the $18,000. Okay. What else should we do when we have a stock dividend? Well, we need to recognize the fact that we are distributing stock. Okay. So the correct journal that we should do, what we should do is we should credit the common stock dividend distributable account. How much? Well, we take the number of shares, 1,000, times the par value, $10. So we get $10,000. Okay? Not done yet. We have a difference between the common stock and the stock dividend, right? $8,000. We should have credited paid in capital in excess of par, common, for the difference. The $8 times the 1,000 shares gives us $8,000. Okay? I'm going to bold this and make it blue. What does this mean? This means what we should have done. We did not do that. Okay? So we need to get from here to here. Right? How do we do that? Very, very easily. Okay? First thing we need to do is just recognize what we should have done. We just did that. Now we need to recognize first we need to recognize what we did. Next, we need to recognize what we should have done. Now we need to fix the problem. Well, if we look at it, we can see that our stock dividend should have been debited for $18,000. It was only debited for $10,000. That's the problem. So guess what I'm going to do? I'm going to debit stock dividend. Usually helps if you can spell. Stock dividend for the difference, right? I booked it for 10,000. It should have been booked for 18,000. So number of shares times, in this case, I'm going to do the difference times $8. We end up with $8,000 debit. Okay, perfect. I should have credited dividends payable, right? Because I have common stock distributable right here, 10,000. Well, it's the dividends payable, right? I hit the wrong account. I hit dividends payable. That's wrong. I should have hit common stock dividend distributable, right? So I need to get rid of this. I need to get rid of that dividends payable. How do I get rid of it? I debit it. So I'm going to debit for 10,000. Now, so I got my stock dividend account back to where it needs to be. It should have been 18. I booked 10. I booked another 8. Dividends payable shouldn't even hit that account. That's not even the correct journal entry. So down here I debited it, got rid of it. Now I can continue with what I should have done. I should have credited common stock dividend distributable for the 10,000 and the paid in capital in excess of par common stock 8,000. So I'm going to do that. I'm going to do that right now, right? I'm going to go ahead and say common stock dividend distributable for the $10,000 and the difference. And remember, I'm using the market price here, so I need to book the common shares at the par and then anything above that to my account paid in capital in excess of par common for the $8,000. Okay? And this, my friends, is the correct answer for number 2. Okay? So let's look at number 3. And bear with me here. I just want to make some more room for us. Okay. Number 3. All right. We had a 4-for-1 stock split. And you know what? Let me just do this. Makes it easier for us. We can read it together. Okay. A 4-for-1 stock split involving the issuance of 400,000 shares at $5 par value stock for 1,000 shares of $20 par value common stock. Okay, we recorded it as a debit to retained earnings of $2 million and a credit to common stock of $2 million. Okay, so what I want you to do is pause the video. And what journal entry don't pause the video yet. When we have a stock split, right, or 4-for-1, whatever, what journal entry do we do? Pause the video, go find that information. Hopefully you know it. You have it in your notes. You should have. If not, get it in your notes. Study that. Memorize that. Okay. So what'd you find out? We don't do a journal entry for a reverse or for a stock split, right? We do no journal entries, right? It requires nothing. We saw in a previous video that when we do a stock split or when we have a stock split, it affects only the par value and it affects the number of shares outstanding. We didn't issue anybody stock. We just said, hey, you had 4 shares or you had 1 share. Now you got 4 of them. Okay, so here's what we did. Now let's go back to the book and we're going to journal entry what we did. Okay, and actually bear with me here. Okay, so the problem tells us we debited retained earnings for $2 million. We credited common stock for $2 million. Oh, sorry about that too. Okay. We know when we have a stock split, we have to make absolutely no journal entry. So we just need to reverse what we did, right? This is what we did. What should we have done? No journal entry whatsoever. No journal entry. Should have been recorded. So what do we need to do? Well, we just need to reverse this. So how do I reverse that? Well, very easy. I just do the opposite of what I did, right? I'm going to debit common stock. Sorry. I'm going to debit common stock. For $2 million. And I'm going to credit retained earnings. For the same amount, $2 million. And there you go. Okay. The next problem, or exercise rather, that I'd like to work on is exercise 14-8. Okay. And here they want us to prepare the retained earnings section for Eddy Corporation. So what we need to do is first figure out, okay, what did we do wrong? What are they telling us? How do we fix it? Super easy, right? So on January 1st, 2017, Eddy Corporation had retained earnings of $650,000. During the year, Eddy had the following selected transaction. They paid dividends. Actually, they declared dividends for $120,000. They corrected the overstatement of 2016 net income because of an inventory error, right? Our expenses were too low. Net income because corrected overstatement. So our net income was too high. We need to lower it. Okay. We declared net income of $350,000. This is in 2017, and we declared a stock dividend in 2017 of $90,000. What we need to do is prepare a retained earnings section for the year. Okay, so if you remember in the lecture video, where are we at? There we go. In the lecture video, I said, hey, you're going to need to know that slide and how to correctly put together the retained earnings statement, right? So I'm going to click a new page. It's going to be exercise. Oh. Rename. This is exercise 14-8. Okay. And no debits and credits. Why? Because I'm preparing the retained earnings statement. So we need to do this in proper form, always in proper form, please. I'm going to count over 1, 2, 3, 4, 5. I'm going to count over 6 columns. I'm going to merge and center, get my small crosshairs, click and drag down 3. Then I need to make room for the titles and the accounts that I'm going to have. So I'm going to come over the first 4 columns, merge and center, left align, and I'm going to click and drag these down. Okay, so we're doing the Eddy Corporation. So whenever we do a financial statement, it has to be in proper form. We need to have the heading. The heading says first line has our company name. Second line has the name of the financial statement that we're doing. So we're doing the retained earnings statement, or statement of retained earnings. And we need to specify the time period. Well, retained earnings is not like a snapshot like the balance sheet is, right? Think back to last semester when I said, hey, we got to understand the time frame that all of these financial statements cover. And we said that we used the example of either a Polaroid picture or a video. We said a video covers a starting point and a stopping point, right? A Polaroid picture captures what something looks like at a specific time, right? Well, this is the retained earnings. We need to show how the account changed from January 1st, 2017 to December 31st, 2017. So it needs to function like a video. So what time period am I covering? For year ended December 31, 2017. Okay. So first thing I need to do is put my balance as of January 1. And as reported, they told us it was $650,000. Okay, we know that's wrong, but that's okay. That's first. Here's what it was reported at. We found a previous error that we made. Okay, no problem. So the next line is going to be the correction for the overstatement of 2016 net income, right? So I'm going to say overstatement of 2016 net income. And I'm going to say that this is a inventory error, because that's what they told us it was, okay? So I need to subtract out $40,000, right? We overstated it by $40,000. We were $40,000 too high. We need to fix it. We're fixing it now. How are we fixing it? By showing on the statement that we are subtracting out, that we are subtracting out the overstatement of that net income. I'm going to subtract these two. I get $110,000. What is this? This is the balance. January 1 adjusted, or as adjusted. Okay. Now we need to go ahead and we need to go ahead and prepare the retained earnings section, right? This should be a no-brainer because we did this in accounting 1. So the first thing I need to do is I need to add things. What do I need to add? Well, I need to add net income, right? What was the net income for 2017? Well, the problem told us it was $350,000, right? So I'm going to add up my beginning balance as adjusted plus the net income. Retained earnings, $960,000. And not done yet, right? They told us we paid a cash dividend and a stock dividend. Okay, so I need to subtract out the cash dividend, which they told us was $120,000, and I need to subtract out, I want these to line up nice, so I need to subtract out the stock dividend, which was $90,000. Okay, so if I add these up over here, I see that I need to subtract out $210,000 from my retained earnings to end up with the ending balance. So if I take my $960,000, subtract out my $210,000, I get $750,000. This is the balance at December 31. Now remember, we're not done yet, right? To show that we're done, we need to put in our double bottom border. So I'm going to go ahead and do that. And now we're done. Okay? So that is how you put together the retained earnings statement when there was an error or a previous statement error. Okay? When we come back, we're going to finish up talking about chapter 14. So please tune back in for that video.